Welcome to Sprott Media, joined today at the NASDAQ market site in New York by attorney, economist, author, long-term capital management survivor, Bitcoin assassin, and best-selling author James G. Rickards. He's also the co-founder of Merigleam, a predictive analytics company, and the best-selling author of Currency Wars, The Death of Money, The New Case for Gold, Road to Ruin, and his latest book, Aftermath. James, thanks for joining me here today in New York.
Great to be with you, Albert.
I want to get into the book, obviously. I want to get into the conference that you'll be headlining for us in July. But first, I want to just talk about some of the news. And let's talk about the quarter we just closed off.
Right.
Risk on, lots of enthusiasm, huge gains in the S&P. On the back of some good news coming off some good news from China as well. So what are your thoughts on the quarter we just had? And then on this trade war, the state of it, which you predicted a year and a half ago with me in Vancouver. What are your thoughts on both of those?
Well, it's rarely helpful to look at an individual quarter because there's so many variables, inventories and trade deficit or surplus. Well, we haven't had a surplus in a long time, but trade deficit, et cetera. But I tend to look at a series. So, for example, let's go back to the second quarter of 2018. Okay. Real growth was over 4%. It was 4.1, 4.2. And everyone was like, happy days are here again. The tax bill worked. The Trump policies are working. It's Steve Moore, Larry Kudlow, others projecting 4% growth or over 3% growth or 4% growth as far as I can see. The third quarter then dropped down to about 3.6, give or take. The fourth quarter came down to 2.2 when it was finally revised. The first quarter of 2019, we don't have the numbers yet. We won't have the official numbers until the end of April. But estimates are maybe 1.7, somewhere 2, somewhere in there. So when you look at the trend, 4 plus, 3 plus, 2 plus, barely 2, right. It looks like we're getting back to the 10-year trend, which is 2.23%. So did we get a little pop in the second quarter of 2018? Yeah, probably due to the tax cuts, understood. Mm-hmm. But that was just a pop. It did not create the sustainable trend growth that everyone's been looking for 10 years. So look, and by the way, Trump's first year, 2017, was almost exactly 2.2%, identical to Obama's 8 years. So it's not horrible. I'm not saying there's going to be a recession, but it looks like Trump's trending the same way Obama trended, which is kind of coming back to that central tendency of around 2.23%. That's at that level, the country's going broke because the debt's going up faster than growth, even nominal growth. When you add in inflation, the debt's still going up faster.
Let's talk about these sort of one-off pops for a minute, because it seems like the Fed and the White House, they've pulled so many rabbits out of the hat. I mean, taking interest rates to zero, QE, then you have fiscal stimulus, and you have repatriation, right? So on and so forth. At this point, they're running out of tricks. They're going to be looking for loose change in Air Force One or in the Oval Office, in the cracks in the couch. Do you think that they've run out of tricks? And do you think that the yield curve inverting and central bank posturing, that they're going back into a loosening cycle, suggests that we should be on recession watch now?
Yeah, I wouldn't say they've run out of tricks, but it's important to know that they are tricks. In other words, the real danger is not that they don't have a trick or two up their sleeve, but that they can't step off the stage. They can't withdraw from market manipulation, policy rate manipulation, money supply manipulation to try to prop up the economy. They would love to kind of go to the sidelines, have what they regard as a theoretically neutral rate, maybe intervene if there's another crisis or another recession, or cool things down if there's inflation, but otherwise just kind of go on autopilot. That's what they would like to do. They can't do that because they're in so deep, they can't get out. Now remember, QE ended in 2014. The interest rates started increasing in 2015, so that was the beginning of tightening. It was very slow at first, but they picked up the tempo in 2017, 2018. And quantitative tightening, I run into people all the time who go, I hate QE. I say, well, sorry, QE was over 4.5 years ago. We're into QT, quantitative tightening. Right. So you were getting a double whammy. They were raising rates 25 basis points every quarter like clockwork, and they were burning money. Remember the famous cartoon of Bernanke hanging out of a helicopter, like a manic look on his face, throwing dollars? That was QE. Picture Jay Powell at a furnace with a pile of $100 bills, shoveling the money into the furnace, because that's what they're doing. They're burning money, reducing the base money supply. That is estimated to be the equivalent of another 1% of hikes per year, or 425 basis point hikes. So they were raising rates effectively 2% a year off a 2% base.
Right.
And that was the extreme version of tightening. So what happened? We all know the stock market pretty much melted down between September and December of last year. You had the Christmas Eve massacre. And that's when the Fed pivoted and said, they used the magic word pause. Whenever they say pause, I think people are onto this now, but it was true going back to 2015 when Janet Yellen took the word pause out of the statement. But when they say pause, they mean we're not raising rates now, and we're not going to raise rates in the future without giving you a heads up. So when they do the June statement first, so they're not going to raise rates in June because they use pause in March. See what they say in June, but if they use the word pause, that means they're not going to raise them in September. So you can accurately predict the Fed 3 months in advance by whether they do or do not have the word pause in the statement. So pause is in, so they're not raising rates. And they also said they're going to taper QT. It gets complicated. They taper QE, now they're tapering QT, and they'll be at 0 reduction in base money by September. So that ease lifted the stock market. You had the Christmas Eve massacre, but then you had the Boxing Day rally, and it's been rallying ever since. However, the stock market still has not reached the old high, going all the way back to January 2018. So it's actually had like a triple top within 20 or 30 points, around 26,600 on the Dow, give or take. There's been sort of a triple top. It doesn't seem like it's able to get through there. And now that it's getting close to that level, it's kind of going back down again. That's a recession sign. It means the bull market's over. The inverted yield curve is a recession sign. None of this is determinative, but it all bears watching. Let's just say we're uncomfortably close to a recession. And one last thing, Albert. Remember, monetary policy works with a lag. The slowdown in the economy that we're seeing right now, we talked about first quarter growth, and the stock market not really getting traction. This is the result of monetary policy in 2017, the tightening in 2017. It takes a year to get also in early 2018. Now the Fed's trying to ease relative to expectations, fine, but that won't really affect the market until a year from now. So right now we're just skating on the edge of recession. I don't think we're going to have a recession, but we're uncomfortably close.
Okay, I want to pivot over to the book Aftermath. It's your 5th. I think if you no more books. I'm not going to be able to keep up anymore in the introduction.
Well, I'll talk to my agent about that.
But Aftermath coming out in July. I read about 3/4 of it. Okay. Loving it so far. Love the way you write. And one of the things is the stories that you put in there are very interesting, and it's amazing discipline to me that you held back some of this stuff until your 5th book. You must have been pretty confident that you were going to keep writing, because some of that stuff is just too good to keep out of sight.
Yeah, well, thank you. I mean, it's sort of the new book, Aftermath, coming out July 23rd. You can pre-order on Amazon or Barnes & Noble. But it's really the 4th volume of an international monetary quartet. So take my book, The New Case for Gold. Put that to one side. That's a specialty item. It's a manifesto. I hope people read it. But the 4 volumes of the quartet are Currency Wars, The Death of Money, The Road to Ruin, and Aftermath. And that will complete the quartet. I've analogized it loosely to the 4 Horsemen of the Apocalypse. But it does 2 things. It has a lot of economic history, which I'm always surprised if people don't know. You talk to younger people and they go, oh, did we used to be on a gold standard? Or it's only because no one ever taught them. But there are a lot of things, as the Fed only started in 1913, it wasn't around in the second half of the 19th century. No, we did not have a central bank, et cetera. So some economic history, and then kind of getting into the issues of the day. Currency wars were red hot in 2010, 2011. One of the things I said then was that this currency war will last 10 or 15 years. It's not a headline, it's not the flavor of the month.
Right.
You can't get out of them. And we're still in a currency war. We're still worried about China. One of the big negotiating points with Ambassador Lighthizer and the Chinese team in terms of the China-U.S. trade wars is, will they use currency manipulation? So it's still a front and center issue even here in 2019. But then the death of money kind of focused on Europe and China a little bit more. The road to ruin takes you into the crisis. So it says, okay, here's what it's going to be like to be in the crisis that's coming. Here's what the IMF is going to do, here's what the Fed's going to do, et cetera. They're going to freeze accounts, shut the stock exchanges, because they won't be able to bail it out again. They printed $4 trillion to bail it out the last time. notwithstanding what our modern monetary theorists say, you're not going to be able to print another $4 trillion to bail it out. So you're going to have to turn to the IMF, and that has a lot of implications. The new book, Aftermath, sort of looks through the crisis. Now, again, it's got some history, it's got some analysis, so it continues this chronicle of events and brings them completely up to date. In fact, I was just making a few changes the other day. But it also looks on the other side of the crisis. Here's what life will be like, and we're not helpless. Here's what you can do today to prepare for that eventuality.
Right, so each tip has investment, I mean, each chapter comes with some investment reflections.
Correct.
To make it very actionable. But I like the history, and I was very intrigued by the comparison you made at the very beginning to the Odyssey. So I'm thinking, Janet Yellen, these central bankers, are they the protagonists in the story, or are they the six-headed monsters?
Right.
How do you see them? As because you sort of look at them as the heroes in some ways, right? Can you talk about that?
Yeah, I guess Jay Powell at this point has to be Odysseus, because he's trying to get home. He's trying to get back to where we were. But I make the point in the metaphor is that before Odysseus was returning, where was he returning from? He was returning from the Trojan War. So let's talk about the Trojan War a little bit. And that was that was Bernanke and Yellen and QE and all the things they did. That's all over, and now Jay Powell is trying to get back to normal, trying to get back to his home and his family, metaphorically, and it's difficult.
The people who preceded him, do you see them as heroic at all?
No, I've spoken to Bernanke, kind of one-on-one about some of this. I have a theory on the Princeton Economics Department. They should treat it like a level 3 hot zone, like where they test, germs and things that could wipe out the population. Keep it contained, but don't let them out. Don't let them into the Fed and places like that where they can have a real impact. What Bernanke told me was he's a great admirer of FDR, and he made his scholarly reputation studying the Great Depression. And what he liked about FDR was not an economist, didn't exactly know what he was doing, but he was determined to try. He would try one thing, it wouldn't work, fine. Try something else, that didn't work. Try something else, oh, that worked, we'll do more of that, etc. He liked the, if not pragmatism, at least the willingness to try different things. So what Bernanke said, faced with what he thought were the same situation that the Federal Reserve was facing in 1929, he said, well, we'll cut interest rates to zero. Sure, you do that in a crisis, you have to do that. But beyond that, to get the economy back up to trend growth, he invented QE. Now, I want to emphasize the word invented. It had never been done before in the history of the Federal Reserve.
Right.
Yeah, normal system of market operations, you print a little, you withdraw a little, you tweak it as needed, and then you kind of grow the money supply over time to keep pace with the economy. But that's not what Bernanke was doing. Bernanke was doing something completely unprecedented. It was kind of a crazy theory. He thought if we kind of lower rates on 10-year notes, it's going to force money into other asset classes, the chase for yield. We call it the portfolio channel effect. So if I make the 10-year note unattractive, you'll go buy real estate and stocks. That'll increase those values. That will then be collateral for more borrowing. That creates more spending. So you get into the lending spending cycle again. And by the way, when the asset values go up, people feel richer, and the wealth effect is that they'll go spend more, and this is going to get the economy back to trend. Everything I just said is false. In other words, it is what Bernanke was doing. It is what he thought. But it's bad science, bad economic science. There is no wealth effect. The evidence for the wealth effect is very, very thin. All he did was create asset bubbles. So now, here we are. By the way, do you think anyone at the Fed in 2010, when they started QE2, thought that we'd be in 2019 and they would not have been able to normalize and we'd still have below trend growth? Nobody thought that would happen. They thought, yeah, give us a year, give it 2 years, whatever. But anyway, here we are. Powell, starting with Yellen and now Powell, they're trying to extract themselves from this. And by the way, that's why the Fed's been raising rates since 2015. There was the normal business cycle reason to raise rates. Well, you see inflation, or there are capacity constraints, industrial capacity constraints, utilization, labor market constraints, things are too bubbly, et cetera. So we're going to raise rates a little bit to put a damper on that. None of that is true. There's not a sign of inflation. There are no capacity constraints, not as long as you got 700 million people in China willing to work for next to nothing. So why are they raising rates? They're raising rates to undo the damage of taking them so low and keeping them so low for so long. They're getting ready for the next recession. The conundrum is, can you get ready for the next recession without causing recession? And I never thought they could. I know what they're trying to do, but I never thought they could actually do it. Well, apparently Powell came to that realization in late December. He said, no, we're going to cause a recession here. We better back off. But what does that mean? It means that you can't get rates back to normal. You can't get the balance sheet back to normal. You have to keep appeasing the stock market, or they'll be up in arms. And there's no way out.
There's no way out, and indeed. I want to pivot to something else. You had a little fun in your book talking about behavioral economics, choice architecture. You made reference to your Audi beeping at you and talking to you. Tell you personally, if I ever find the person who designed the microwave oven in our, I'm going to punch him in the throat.
Yeah, exactly. Right.
I think it's super annoying.
Yeah.
Can you talk about, describe the problem? Why do you think it's so relevant?
Well, here's the thing. Behavioral economics, they say behavioral economics. It's really behavioral psychology. But then you can take the psychology and apply it to economic policy, and then it becomes behavioral economics. Behavioral psychology is great science. I mean, the experiments bear it out. Whether it's Daniel Kahneman or Amos Tversky, who passed away, or Dan Ariely, these are brilliant contributors to this field. My objection is not to the science, because the science is good. My objection is the application of the science to manipulate behavior. Because I say, well, why would you do that?
By the state, right?
By the state, exactly. Well, by the state, but it's also very big in the private sector. Meaning,
right? But is that sinister when it's done as a sales tool in the private sector? Is that?
Well, I would say it's more than a sales tool. Yes, a sales tool, but more than a sales tool. It's like you can predict with a high degree of accuracy how people are going to answer certain questions. So if you change the question, you get a different answer. I'll give you the classic example. So you go to work, you get a new job, you go to work, and they give you your new employee package, and you're filling out all the information. And there's a box that says, do you want to join the 401k? And there's a brochure or something attached to it. And some people say yes, some people say no. What if you change the question? You say, you're in the 401k. Would you like to opt out? The participation rate for the second question is much higher. You get 90% participation if you say you're in, do you want to opt out?
Right.
Then if you say, do you want to be in, that's much lower, maybe closer to 50%. So just changing the question increases the participation rate by 40%. Now, why is that? It's because people don't like to check boxes. I mean, it sounds like some great, Einsteinian insight. People don't like to check boxes. So if you make them check the box to join, they won't do it. But if you make them check the box to get out, they won't do it either, because they just don't like checking boxes. So by changing the question, you manipulate behavior, you get much higher participation rates. Is that a good thing or a bad thing? Well, obviously the people who do it think it's a good thing, but what are they saying? They're saying they're smarter than you are, or they're smarter than I am.
Absolutely.
Right, so they're interjecting, they're putting their judgment out of the individual judgment. They're using behavioral tricks to get very predictable results in behavior, which is kind of manipulation. And it's based on a very arrogant assumption that they know more than you do. So I worked through a long example, it's not that long, it's a couple of pages, but of two employees going to same company, same job, same salary. One joins the 401k, one doesn't,
right.
But the one who doesn't buys gold. And then I track it over almost 20 years, and the gold actually outperforms the 401k person who was all in stocks after tax. So I'm not saying put all your retirement savings into gold. I'm not saying 401ks are horrible. I'm just making the point that the eggheads, Richard Thaler and Cass Sunstein and the other professors who push this stuff think they know more than you do, and that's a false assumption.
That's the main point, right? It's a lack of humility. The PhDs don't always know what's best.
Right.
We know that. They apparently don't know that.
And one of the things they say is, like, this is good stuff because it's very low cost, and we're not telling you what to do, we're still giving you a choice. Well, that's really in bad faith, because they know how people are going to behave. So that's where the manipulation aspect comes in. But they say, well, there's no cost associated with it. That's not true, because, okay, one check of a box, no big deal. But from the time you wake up to the time you go to bed,
yes.
and maybe when the alarm clock goes off in the morning, the word they use is nudge. We're not telling you what to do, just giving you a little nudge here. Well, nudge here, nudge there. Your car's beeping at you, your microwaves talking to you, your Alexa's spying on you, which not a lot of people
right.
realize those things. They record you, and it's to the point now where the Alexas, and I don't know the names of all the other brands, but there are a bunch of them out there, these speaker assistants, they actually talk to each other. Now they're robots, now I say
right.
talk, let's put that in quotation marks, but they can monitor your behavior, and if they decide that your behavior is antisocial in some way, they'll actually call the police on you. Right. So if I had one, I don't, but if I did, I have another tool called a sledgehammer. I would just put it in a piece of asphalt and hit it with a sledgehammer. But people, the manipulation, the bad faith, the spying, the monitoring are just totally out of control. And all I do in the book is I just call attention to it. I say, look, whether you're applying for insurance, applying for some medical plan, getting a new job, think about these boxes, think about these choices, because there's someone over here paid by the insurance company or the healthcare company or the employer, whoever, to force you into certain things in ways that you don't even understand. And my question, I spoke to Dan Ariely, and we were in Switzerland at this resort way up in the Alps, and I said, Dan, I said, this is powerful stuff. I said, you know it, I know it. And your guns for hire, they get paid big consulting fees. It's called choice architecture. So architecture meaning we're going to force the choice. But I said, what if some extreme right wing or extreme left wing, some neo-Nazi or neo-fascist or ultra-communist politician hired you to do the same thing, kind of to do propaganda for them.
Right.
And he said, I would never do that. And he said, well, I have a test. He said, my test is, if I wouldn't do it for free, I won't do it for money. And that's a good start. I gave him credit for that, but I also said, well, it's a highly subjective filter, because who knows what people will do for free, and maybe not everyone's like you. And so as these tools fall into the hands of a larger group, it's not just people trying to get you to sign up for maybe some insurance you don't need. It's people trying to force political choices, and it's just another branch of propaganda.
Right, and it's value substitution at minimum, even though, like you mentioned in the book, he is a good guy, he thought about it, he said, okay, no monetary compensation, you're still substituting your values for mine.
Right.
One comment before we move on, I was thinking, really enjoyed that chapter, and I think they're being a little disingenuous here about changing the question, because yes, people don't like to check boxes, but what they really don't like is to read all of this stuff, to understand what they're checking. And so one choice comes with a burden, the other choice doesn't. And if that's the way you're going to architect the choice, then why not give them faulty pens? Hey, if they want to check the box, they'll ask for a good pen.
Yeah, or
turn the lights out.
Or actually check the box in advance and say you have to erase it if you don't like it.
Right, make it even more hard. Where's my PhD? Yeah. Where's my Nobel Prize?
Yeah, this is a non-benign manipulation, and it's not done in good faith.
Right. As we're coming to the end here, James, I just want to tell the readers about this book. I've enjoyed this copy.
Thank you.
I guess the book is going to be declassified July 23rd.
Right.
If we can get a shot of this, you can pre-order it now on Amazon, as you mentioned.
Right.
But a better idea is to talk to me about how to get it for free. Contact me with a link on the bottom. I'll get you a copy, and I'll also tell you how you can get it signed by James Rickards. All you have to do is come to our symposium this year in July, and we'll hook you up with the book with James. Thank you, James, very much for joining me today. It's always a pleasure.
Thank you, Albert.